Hi everybody, this is Mike Klinger, and today I'm going to be talking to you a little bit about how Social Security looks at income when somebody is receiving Social Security Disability Insurance, or SSDI, and they're self-employed. This is the second part of a two-webinar series. Last month I gave you an overview of how they look at self-employment income for people who are receiving SSI, and today we're going to be talking about how they look at income when somebody receives SSDI. As we go along, you'll notice that there are some similarities and some differences in terms of how they look at substantial gainful activity, or SGA, for employees versus self-employed people. One of the biggest differences is the work incentives that can apply when somebody is self-employed that aren't available to employees. And we'll talk a little bit more about that as we go along. The first thing I want to talk to you about is how Social Security looks at income when somebody is self-employed and in their trial work period, or their TWP. And if you've been a WISA for a long time, or if you're a counselor for a long time, you should all know what the trial work period is, so I'm not going to get into that. What I do want to say about TWP, though, is that how it differs from employees, where the Social Security is looking at the gross amount of income that a person earns in a month during the trial work period. If somebody is self-employed, they're looking at the net earnings from self-employment, or the NESC. Okay. So going back to what I said last month about NESC and SSI cases, the same thing is true in SSDI cases, where Social Security is not going to look at gross profits or gross earnings. They're always going to look at net earnings from self-employment during the trial work period and to determine SGA going forward. Okay, so they're never going to look at gross, and in an SSDI self-employment case, it's always going to be net earnings from self-employment. Okay, so how Social Security determines that is by looking at the person's gross receipts, or their gross profit, minus any business expenses that the person has to pay for out of pocket to operate their business. And these are all expenses that are deductible in terms of the IRS code on a person's taxes. Okay. From that, they multiply the remainder by 0.9235 to determine how much NESC is countable for the month. You may remember last month when I talked about how it's determined in an SSI case, I said that it was gross income minus expenses multiplied by 0.9235. The same formula applies in an SSDI case too. Okay, so that's how they look at it. Another thing I'm going to say in terms of expenses is, again, these are all expenses that are deducted under the IRS code that a person pays for out of pocket. You guys, as WISAs and VR counselors, are not tax experts, and you're not expected to be. Your only job is to advise people on how self-employment income impacts benefits, not to give tax advice. So my suggestion would be, if they have specific questions about what sort of expenses the Social Security will deduct from their gross receipts during that trial work period, I would refer them back to the IRS or their tax professional. You don't want to get too much in the weeds on giving tax advice, okay? But it is gross receipts minus expenses under the IRS tax code multiplied by 0.9235 to determine how much net income from self-employment is countable, okay? So keep in mind that during the trial work period, Social Security will assess the NESC on a monthly basis if possible. So if a person has monthly profit and loss statements, or a tax return if they've been at the business for a while, and they can provide those things to Social Security to show what their profits were and what their expenses were, then Social Security can use that information to determine how many trial work period months have been used. If the beneficiary does not have monthly records or monthly profit and loss statements to show profits and expenses, Social Security can actually average net earnings from self-employment over a period of several months. if the person has no records and they have to take an estimate of NESE during the trial work period. And I'll talk a little bit about averaging and how that works in a little bit. The one thing I want you to keep in mind is that similar to how no work incentives apply during the trial work period, and in a case where a person is an employee working for somebody else, the same concept applies if somebody is self-employed. Okay, so if they're still within that 9-month trial work period where there's no limit on earnings, no other work incentives apply. Okay, so just keep that in mind, that a person on SSDI can use work incentives, but only after the trial work period is completed. Okay. Another thing, a difference between employees and self-employed persons is that with an employee, as you know, if a person's gross earnings for a month exceed the trial work period limit for any given year, they're determined to use one trial work period month. Okay, you all know that. The difference in a self-employed case is that once the net earnings from self-employment is figured, if the NESE does exceed that trial work period limit, the person is going to be considered to use 1 month just as an employee would. But the difference is that Social Security also looks at the amount of hours that a person works in a month when they're self-employed. That matters. So right now, the trial work period guidelines say that if a person is self-employed and their net earnings from self-employment exceed the trial work period limit for 2023, or if they work more than 80 hours in a month, they're going to be considered to use one trial work period month, regardless of whether or not they exceeded that trial work period guideline. So even if the net earnings from self-employment are less than the trial work period guideline, when somebody is self-employed, just keep in mind that Social Security is also concerned with the amount of hours that they work in a month, not just how much their profits were. Okay, so if a person works more than 80 hours a month, just keep in mind that they can be considered to use one trial work period month, regardless of what their profits were. Okay, so that's one big difference between employees versus self-employed people. This next slide just goes back to what I was just saying on the last slide. I got a little bit ahead of myself, but this one talks about when a trial work period month is used. So I'm not going to take too much time on this. I've already covered it, but remember that a trial work period month is used in a self-employment case if the net earnings from self-employment for the month exceeds the current trial work period amount, which, as you know, is $1,050 for 2023, or if the beneficiary works more than 80 hours in a month, regardless of whether those net profits exceed the guideline. Okay, so just remember that the amount of hours they work in a month matters for trial work period purposes. And just as a tip to a beneficiary, if you are a WISA or a VR counselor who is working with a person who is self-employed, advise them to track and document all the hours worked every month that they work, in addition to keeping profit and loss statements, because again, the amount of hours that a person works matters, and Social Security is going to want to know how much time that the person invests in running their business every month. So make sure they keep track of that, as well as profit and loss statements for income reporting purposes to Social Security. So just a couple quick tips on what records a person should keep if they're on SSDI and in their trial work period. So in order to calculate whether a trial work period month has been used, Social Security is going to need and look at a couple of things. One is going back to what I said on the previous slide about monthly profit and loss statements. That's something that the Social Security Administration would use to determine whether a person uses a trial work period month. A statement of the hours worked in a month by the beneficiary. Talked about that a little bit on the previous slide. And if a client has been with their business for a while and they do have a tax return, Social Security is going to ask for a copy of that tax return too to determine what the countable NESC has been for a particular period, because the tax return will show profits less business expenses. Okay, so the tax returns are only going to be used when monthly statements are not available, and when Social Security has to use income averaging to determine whether a trial work period month is used. And again, I'll talk a little bit more about averaging in just a couple minutes. But if a person can keep monthly profit and loss statements, it's a little bit easier to keep track of how many months in the trial work period were used. And again, going back to what I said in the last webinar about the person using the SSA 820 form, if they were on SSI, that's the work activity for a self-employed person report. A person can use the SSA 820 if they're on SSDI 2. They can use that to document any profits, any business expenses that they have, how many hours a month that they worked. All that information is in the 820 report. So for work reporting purposes, if somebody's on SSDI and they're self-employed, they want to submit a copy of that 820 report detailing profits, any expenses, and hours worked, along with submitting any profit and loss statements that they have for the months that they work. Okay, so Social Security is going to be looking at all those things when determining whether or not a TWP month has been used. So similar to when somebody is an employee working for somebody else and they've used their 9-month trial work period, after that, the Social Security is going to be concerned with whether their monthly earnings show a pattern of substantial gainful activity, or SGA. Okay. Same concept is true in a self-employment case. So once somebody uses their 9-month trial work period and their grace period, SGA is going to become obviously a factor, just as it would in a case where somebody was an employee, but with a couple differences. So going back to what we said before in previous slides, is that instead of looking at the gross monthly income that an employee would receive, Social Security is going to look at net earnings from self-employment after any allowable deductions for business expenses. Okay, so that's number one. That's the one big difference. The second difference in determining self-employment and whether or not that work is SGA, Social Security is always going to apply one of two tests to it. Okay, and the first one I want to talk to you about is the countable income test. So this one applies to beneficiaries who have received benefits for at least 24 months. So in order for this one to apply, they would have to have been receiving SSDI checks for at least 2 years. But it does not apply if Social Security ceased benefits earlier in the extended period of eligibility. So let me give you an example of that. Say somebody was, or they had completed their 9th trial work period month rather, and they've used their grace period, and Social Security has determined that they're no longer eligible for benefits because their net earnings from self-employment are greater than the SGA guideline and benefits cease. They would not be held subject to the countable income test if they had a cessation of benefits already. Okay. This test always applies if a person is on SSDI and they meet Social Security's definition of blindness. But if a person has either been on SSDI for less than 24 months, they have not had a cessation, and they're not blind, Social Security is going to use the 3-step income test in all other situations. And I'm going to talk to you a little bit about how that works on the next slide. So if the countable income test does not apply, Social Security is going to look at the second test, which is called the 3-step test. And this is used in a couple situations. Number one is going to be used at the initial eligibility determination when somebody first applies for benefits. So as you know, when somebody applies for benefits, they have to meet a 2-part test. Number one, their disability has to have lasted for at least a year, or is expected to end in death, and they have to show that their impairment renders them capable of earning substantial gainful activity level earnings. So if somebody is maybe medically disabled, but they apply for benefits and Social Security finds that their net earnings from self-employment are greater than the SGA guideline at the time that they apply, they're going to be denied benefits based on their earnings. Okay, so when somebody first applies for benefits, they're going to be looking at this three-step test. When a beneficiary has received benefits for less than 24 months, the three-step test applies also. So if somebody is receiving benefits for more than 2 years, they're going to be looking at the countable income test. Benefits for less than 24 months, they're going to be looking at the three-step test. Okay, so for example, if somebody has only been receiving benefits for, let's say, a year, and they go to work and they're self-employed, Social Security is going to evaluate their countable income looking at this three-step test. It also occurs and is used when a cessation decision has been made. So, for example, if somebody is, let's say they've used their trial work period, they're in their extended period of eligibility now, or their EPE, Social Security finds that their earnings are more than SGA rather. Those benefits are going to cease, as long as those earnings are at SGA levels. Okay, so if somebody is in their EPE, they're working over SGA and their benefits have ceased, then SGA is going to be evaluated using this three-step test. Last thing is it also applies during the initial reinstatement period, or IRP, for EXR cases. So this is not a training in EXR, but just to recap, if somebody is on benefits and their benefits have terminated because they've earned more than SGA, sometimes people can go back to Social Security if their earnings fall below SGA, or if they have to stop working due to a disability. They can request expedited reinstatement of their benefits as long as the termination happened less than 60 months ago. Okay, so as you may know, if you've been doing this for a long time, that once somebody has been receiving EXR payments for 2 years or 24 months, they get a whole new set of work incentives. So they get a whole new trial work period, a whole new EPE, they get a new EXR period where they can request benefits again if their benefits stop. But if somebody is in the IRP, that 24 months after they first become eligible for EXR, Social Security is going to use this three-step test to evaluate their earnings when looking at whether or not the earnings are over SGA. And I know that that's probably really confusing, the countable income and three-step test. So what I'm going to do is I'm going to break it down on the next couple slides and go through each one of them in a little bit greater detail, just to make sure that it's clear for everybody. On the next couple of slides, I just want to give you an overview of what the countable income test and the three-step test mean for the purposes of evaluating whether or not somebody is engaging in SGA if they're self-employed. And we'll talk about the countable income test first. So Social Security is going to compare the average monthly countable income, that NESC, to the SGA guideline. So whatever SGA is for the given year. And that average monthly NESC is determined by taking the annual profits after any deductions and divided by the number of months in a representative period. And that representative period only includes months that the business was operational. And this is a lot different than an SSI case. If you listen to the webinar I did on SSI last month, I talked about how if somebody's self-employed and they're on SSI, Social Security is always going to take the annual profits for the year and divide by 12, regardless of whether or not the person was working at the time. In SSDI cases, it's different. In SSDI cases, they're only going to divide the annual NESC by the number of months that the business was operational for the year. So, for example, if you have a client that you're working with that started a business in June and it's December, then they're going to take the annual NESE and divide by 6. So it's only going to be divided by the months that the client worked for the year in that business. Okay, so keep in mind that whether somebody is on SSI or SSDI, how the average NESE is determined is going to vary depending on what benefit they get. Another thing to keep in mind is that all work incentives apply, so they can use things like IRWIs, impairment-related work expenses. You all know what IRWIs are. I'm not going to take a whole lot of time to delve into that. But keep in mind that IRWIs can only apply if the beneficiary did not already use the cost of that as a business expense. So if somebody has something that's business related, work related, that they paid for out of pocket, that's disability related, and they've already claimed that as a deduction on their tax return, they can't use it as an IRWI. So Social Security doesn't allow people to double dip in that situation. Okay, the only time that a person can use an IRWI if they're self-employed is if they already have not deducted that as a business expense. Okay. The next two work incentives that apply are specific to people who are on SSDI and self-employed. This is not one that's available to people that are employees. This is specific to self-employment, keep in mind. One is unpaid help, and the next one is unincurred business expenses, and also unsuccessful work attempts are factored into that. And unsuccessful work attempts also apply to people that are employees, but unpaid help and unincurred business expenses don't. And I'm going to have some slides later on that talk about all these things in detail. So we'll make sure that that's clear for everybody what those are and how they apply. When the three-step test applies, Social Security is going to be looking at a couple different things. So the general rule for evaluating the work activity of a self-employed individual for determining whether or not their work is SGA consists of 3 separate tests. And Social Security is going to look at all 3 of these things before it can be established whether the individual's work is SGA or not. The 3 tests are used if the countable income test does not apply. Okay, so just, if you go back to the previous slides if you need to, where I talk about the differences between when the 3-step test and countable income test applies. If the countable income test applies to your client's situation, the 3-step test does not. Okay, keep that in mind, that it's either one or the other. Okay, this is only true if the 3-step test applies. So go back to the previous slides if you need to refresh your memory on that. But when the 3-step tests apply, Social Security is going to be looking at a couple of things. Number 1, test 1 is significant services and substantial income. Test 2 is comparability of work activity. And test 3 is the worth of the work. So what is the value of the work that the client has performed? And in the next couple slides, I'm going to break down each one of these tests and explain in a little bit more detail what they mean. So the first part is test 1, significant services in SGA. And what does Social Security mean by significant services? If a person is a sole proprietorship and they're working for just themselves, they're automatically considered to be performing significant services. Okay. If a person has a business partner or they're working with more than one employee in the organization, they're going to be found to be providing significant services if they spend at least half their time that they work in a month performing management duties, or if they exceed 45 hours a month in performing management duties. Okay, so if a person is a sole proprietorship, there's significant services being performed according to SSA's criteria, or if they're working with more than one employee and they contribute at least 45 hours a month to the doing of management duties, they're going to be found to be doing significant services. Okay? So if they meet part 1, Social Security is going to look at part 2. they're going to look at whether or not the income being derived from that business is substantial. And so number one, if countable income exceeds the SGA guideline for the year, that work is going to be considered substantial. Okay, everybody knows that that's listening. That's true whether a person is an employee or self-employed, even though Social Security may count the income differently when somebody is an employee versus a self-employed person. If the countable income exceeds the SGA guideline, they're going to be found to have a substantial income. Okay, so that's kind of a no-brainer. Everybody knows that part. Second part to this is that sometimes when people are self-employed and on SSDI, even if their countable earnings are below SGA, Social Security may find them capable of performing SGA level work if their livelihood is comparable to what they were earning before their impairment started, or is on track with the profits of other businesses in the area. So say, for example, somebody was an office manager and they performed a ton of administrative tasks and things of that nature and did bookkeeping and several other duties that are involved with being an administrative assistant. They become disabled, they're out of work for a while, they are found eligible for SSDI benefits, and then they go to work working for themselves, and they're able to do all the same duties that they used to do before they became disabled working in the office. They can still help with administrative tasks, they can still do things like bookkeeping. The job that they're doing as a self-employed person in the business that they started is the same type of work that they did before they became disabled. That's an example of livelihood comparable to what they were doing before their impairment started. Okay. Or, if they're making a significant profit, if profits appear to be over SGA after deductions, if profits are on track with other businesses in that community that are providing the same type of services, they can be found to be doing SGA too. So even if countable earnings are not more than SGA, Social Security might find that because they're able to do the same type of work that they used to do before they became disabled, and because the services that are providing to their community and the profits that are making are on track with other businesses in that area, Social Security may say that they're capable of substantial work. So keep in mind that when somebody is self-employed and they're on SSDI, it's not just a clear-cut number figure, whether or not they're above SGA or below SGA. It's a lot more than just a figure. They're also going to be looking at whether the person can do the same type of work that they used to do as they work in that business, and they're also going to be looking at whether or not what the person is earning from that business is on track with other businesses providing similar services in the community. Okay, so that's part of test one. So in order for a person to be found to both be providing significant services and earning a substantial income, all these conditions that I've laid out on this slide have to be true. If they're not, then it's not likely that Social Security is going to find somebody earning more than SGA. Test 2 is that Social Security is going to be looking at is comparability of work activity. And keep in mind that Test 2 would only apply if the person was found to meet the criteria for Test 1 that I talked about in the previous slide. So Social Security has determined, based on the information they have, that the person is both providing significant services and earning a substantial income. Then they're going to move on to Test 2, and they're going to look at the work activity of the person receiving benefits based on their disability and compare that to the work activity of others without disabilities that are working in the same community or engaged in a similar type business. Okay? So an example of that would be what I just went over. If a client is working in the same type of business or doing the same type of job duties that they used to do before they became disabled, and they're working in a business for themselves, Social Security can find that even if their work is not SGA, because they're able to do the same type of work that they used to do, or it's work that's related or similar to the work that they used to do, they may find that the person is capable of working at an SGA level, regardless of what their earnings are. Okay? So they're going to look at things like how much time or the number of hours in a month a person works in a business. Remember what I said on the slide about trial work period? The amount of time that a person invests in a business every month when they're on SSDI and self-employed matters. For trial work period purposes, a person is going to be found to use 1 month if they work 80 hours a month in the business or more. So Social Security is going to look at things like the amount of time that a person invests in a month in growing that business. And they're also going to look at the type of work, the responsibilities, the duties that the person does for the business, the skills that's required, and things of that nature. So again, going back to what I said before, it's not just a clear-cut figure, of whether or not profits are over SGA after any deductions. They're also going to look at the type of work the person's doing and how many hours a month that they're working in that business. All those things come into play when Social Security is determining whether or not a person can work in SGA level earnings. Okay, so if Social Security finds that work is comparable, if the work that the person with a disability is performing is comparable to the same type of work that people without disabilities in the community can also do, then the Social Security Administration might find that the person is doing SGA and is capable of SGA even if the business isn't making very much money or is operating at a loss. Okay. So in my humble opinion, this could be a drawback for certain people who are on SSDI and self-employed, because even if they're earning less than SGA on paper in terms of profits, Social Security can also make an SGA decision based on the amount of work they're doing and the amount of hours a month that they work. Okay, so keep in mind again, it's not just a number figure. I can't emphasize that enough. They're going to be looking at time spent and duties performed that the client is capable of as part of running that business. So test 3 is worth a work, and obviously this one only applies if the beneficiary meets both test 1 and 2. If they don't, then Social Security wouldn't get this far. But if they do, then they're going to look at test 3, worth a work. And this is where Social Security is going to evaluate whether the work activity that the person does for the business is worth more than the current SGA guideline, even if it's not comparable to other businesses in the area that are providing the same or similar services to what the client's business does. They're going to look at a couple of things. They're going to consider the contribution to the work, how many hours that the client puts in every month, and what job duties they're performing for their business, and whether or not their profits are in line with a salary or wage that an employer would pay if they were working for somebody else in a similar position or with a similar job duty. So if their profits are in line with what they could make in a job doing the same or similar type of work activity, working for somebody else, Social Security might find that they're working over the SGA guideline. So even if work activity is less than SGA, they will consider the contributions to work and whether or not the profits they're making is comparable to what they would make in the community if they were working for somebody else. If the work activity is clearly worth more than SGA, then it's considered substantial regardless of the amount of countable income. Okay, so if a person passes all 3 tests, regardless of whether or not they're earning SGA on paper, Social Security may say that based on the amount of time that you're working every month investing into this business, based on your work activity and the profits you do have, we find that you're capable of working over SGA. So it's a lot different, obviously, An SGA determination is a lot different, obviously, for a self-employed person as it would be for an employee in terms of looking at, the worth and value of the time that they spend and the work activity that they do if they're self-employed. I want to reinforce and go back to what I said before, just to make sure that everybody understands. The 3-test system that I talked about in the last couple slides only applies if a client is not subject to the countable income test. Okay, so this is only applicable if a person meets the criteria for the 3-part test. If you have a beneficiary that's been on SSDI for more than 24 months, then the accountable income test is going to apply and the 3-part test is not going to apply. Okay, this only applies in specific situations that I laid out in the previous couple slides. So just want to make sure that I make that distinction and that everybody understands that the 3-part test does not apply to everyone who's on SSDI and self-employed. If you have a beneficiary that has been on benefits for more than 24 months, which is probably going to be a lot of the people that you work with, then Social Security is going to apply the countable income test, and we'll talk more about that as we go along. When somebody is self-employed and Social Security is looking at SGA determinations, the most important thing that I want to reinforce, and I've said this a couple times already, but I want to make sure that it's just clear for everybody, that it's not just the net profits from self-employment that are important for SGA purposes. The value of the work effort is what's most important in determining whether or not somebody is performing SGA. So Social Security is going to look at things like the amount of time that the person has invested in growing their business every month, and the type of job duties that they're working, and whether those job duties that they're doing are comparable to the type of work they did before they became disabled. So the value of the work is really even more important than just what the net profits are, because that all goes into determining whether or not a person's capable of doing SGA. Social Security is looking for a consistent pattern of work behavior. So an example of that would be, say a client started a business in June and they've consistently put in 80 hours in a month, from June to December. That could be an example of a consistent pattern of work behavior where a client has been capable of putting the same amount of hours into the business every month that they work. But keep in mind that Social Security uses numerous tools to assess the value of work. So I always phrase it as like when somebody's self-employed and they're on SSDI, Social Security has a toolbox of different work incentives that they can use to determine whether or not work is SGA. And these all apply to the countable income test, unsuccessful work attempt, and income averaging, IRWIs. Those all apply whether or not a person is an employee working for somebody else or self-employed. And the two that are different, that are only available, again, to people who are self-employed, are unincurred business expenses and unpaid help. So all these things, when Social Security is looking at countable income, are used to determine whether or not the income from the business is SGA. And I'll go through some of the different work incentives on upcoming slides. The first one I want to talk about is income averaging, and this is one that people may be familiar with, but during the trial work period, the actual net earnings from self-employment is assessed monthly if possible. We talked about that on the previous slides in the trial work period section. If month-by-month data is not available, so if the client doesn't have like profit and loss statements to show what their profits were for every month, Social Security can actually average income to determine how many trial work period months were used. Okay. So following the trial work period, the net earnings from self-employment is averaged to account for fluctuations in self-employment income. So income averaging could apply in situations where it might look like net profits are above SGA in a month, maybe net profits are above SGA for a month or two during the income averaging period, but then net profits fall below SGA. So income averaging is used if there's a consistent pattern of fluctuations in terms of like profits above and below SGA within a certain period. And generally, income is averaged over the period that the client works. So again, going back to our example, a client that starts working in June to December, they would average over a 6-7 month period. But there might be need to average over a shorter period of time if one of the following is true. There has either been a change in the SGA level, or there's a significant change in work patterns or earnings. So number one is kind of self-explanatory. They'll average under a shorter amount of time if there has been a change to the SGA guidelines. As you all know, typically the SGA guidelines go up in January every year. So if there has been a change to the SGA guidelines, Social Security will have to average within a shorter amount of period. An example of that would be, let's say somebody started working in November of 2023 and they worked up until, let's say, March of 2024. Social Security can't average that entire period because there was a change in the SGA level between November and January. Okay, so they would only be looking at the first couple months of 2023 and averaging, and then they have to look at the first couple months of 2024 separately if there was a change to the SGA guideline. Or there's a significant change in work patterns or earnings. So, for example, if somebody started a business and they were feeling great, they had their disability under control, they put in, let's say, 80 hours a month into a business for the first couple months that they were working, and then they had an exacerbation of symptoms, and they weren't able to sustain working 80 hours a month anymore. They might have only worked maybe 80 hours a month for, let's say, January through March, and then for the rest of the year they were only able to put in, let's say, half that, 40 hours a month. Because there was a significant change in work patterns and in the amount of time that the person was able to invest in their business because of their disability, Social Security would have to do two separate average periods. One looking at their earnings when they were working at 80 hours a month, and another period averaging earnings when they could only work 40. So the SGA level matters, and also the client's earnings or work patterns matter in determining how long of a period Social Security can income average for. Keep in mind that averaging can never occur across calendar years. So again, there would have to be separate averaging periods if a person starts a business in 1 year, at the end of 1 year, and then going into the next year, they would have to take two separate averaging periods. They can't do it the same averaging period across 2 different calendar years. I wanted to put impairment-related work expenses, or IRWEs, on here because IRWEs can be used for people that are on SSDI or self-employed. But again, if you have been a WISTA for a long time or a counselor for a long time, you all know what IRWEs are. And the criteria for what constitutes an IRWE is the same regardless of whether or not somebody is on SSI or SSDI, and it's the same regardless of whether or not a person is an employee working for somebody else or self-employed. So didn't want to spend too much time on this one, but just to recap, this should all be familiar for everybody. The criteria for self-employment is the same as for wage employees. The expense has to be related to the disability. It has to be necessary to allow the client to work. It has to be paid for by the individual and not reimbursed by another source. And it has to be an expense that's paid for in a month that the person worked. Okay? And Social Security has to determine the expense is quote-unquote reasonable. So most IRWEs are allowable as IRS business deductions. and should be taken as a business deduction because it will lower the person's overall business tax liability. One exception to that is if the IRWI is related to medical expenses. That would be something that probably wouldn't be deductible under the IRS tax code. That would be something that would, if the client had a medical related work expense, that would be better suited as being used for an IRWI. Okay. Keep in mind that if the expense is already deducted on like a profit and loss statement, if the client has already claimed that as a business expense, it cannot also be an IRWI. I think I mentioned that before, but just to reinforce, again, Social Security doesn't allow people to double dip. If they've already deducted an expense that could be an IRWI as a business expense, they can also deduct it for an IRWI for benefits purposes. Okay, so just keep that in mind. I wanted to give y'all an example of when a client can claim an expense as a business-related expense as opposed to when they should claim it as an impairment-related work expense for SSDI purposes. So I've given you the example of Kate. Kate runs a virtual secretarial company that generates $2,000 in gross income in May. So assuming she's passed her trial work period and grace period, on paper it looks like her income is over the SGA guidelines, but she has some questions about what expenses she can use to reduce her countable income. And she needs help from EWISA because she is not sure whether or not she can claim certain expenses as business expenses or these impairment-related work expenses that she's talked about. So these are what her expenses are. She pays $250 a month to a driver to take her to appointments with clients. Okay, so because she's working with clients and because that transportation is needed to meet with her clients, it's obviously a business-related expense. Okay. So public transportation is available in her area, but her disability precludes her from using it. So she needs to pay a private driver to get her back and forth to her client appointments. And again, because it's related to meeting with clients, that's considered a business-related expense. She also receives a physical therapist 3 times a month to assist with her mobility issues, and her copay for these things after insurance is $25. So she's putting out of pocket $25 every time she sees a therapist, and she goes to the therapist 3 times a month. So let's say her out-of-pocket copays are $75 a month for the physical therapy. Now I want to talk to you a little bit about whether or not the expenses that she's laid out for you that she has could be a business expense or an IRWI. So going back to what I said on the previous slide, the transportation services that she's paying for could be considered a business expense because she needs the transportation to get back and forth to these client meetings. These client meetings are part of her operating a business, and so because of that, it could be considered as a business-related expense. But transportation could also be an IRWI too because she can't drive because of her disability. She's precluded because of her disability from taking public transport. She pays for the expense out of pocket. It's not reimbursed. She couldn't work without the services, and it's disability related, work related. She pays for it out of pocket, not reimbursed. It's an expense that she couldn't work without. So the transportation expenses actually meet the criteria for both a business expense and an IRWI. But remember what I said before. She can't use it as both. So when you're working with clients that have expenses that could qualify as either one or the other, you're always going to want to advise them on what would be more advantageous. And for the purposes of transportation, it would be better for her to claim transportation as a business expense and not an IRWI because Social Security will deduct it from her gross profits to determine her net profits when her income is calculated. Remember, they're always looking at that net income from self-employment. It also could be used as a deduction on her taxes, which reduces her tax liability. So generally, it's preferable to claim items as business expenses if they qualify instead of an IRWI wherever possible, because it's going to, number one, reduce her amount of accountable income for SGA purposes, and also, number two, reduce the amount of money that she owes on her taxes if she takes that as a business deduction. What about the physical therapist? The physical therapist, because it's medically related, probably wouldn't be a good example of a business expense. That's more of a personal expense that she pays for out of pocket that's related to her disability. So medical expenses aren't always deducted, or aren't always deductible rather, as business expense under the IRS tax code. However, again, going back to what I said before, we're not tax experts. So if somebody has a question about whether they can use out-of-pocket medical expenses as part of their business expenses, I would refer them back to the IRS tax code or their tax professional. You don't want to give tax advice. But as a general rule, if it's a medical related expense, probably wouldn't be deducting it on their taxes. That's more of an out-of-pocket work related expense that's disability related. So what does that sound like? An IRWI. Okay. So transportation is a business expense, most advantageous to be deducted as a business expense, whereas the physical therapist co-pays that she pays for every month are better suited being used as an IRWI request. Next thing I wanted to talk to you about was unincurred business expenses. And this is a work incentive specific to people on SSDI who are self-employed. It can't be used by an employee. It's specifically for self-employed people. And the amount of these expenses are deducted from a person's profit when Social Security determines whether or not the work activity is over SGA. So an unincurred business expense is an expense paid for by another agency or individual other than the person running the business that has the disability. And a common example is one that I ran into just recently. DARS is working with a person who is self-employed, helped him with his business plan, and is helping him get his business established. And I think that DARS paid something like $3,900 for his laptop and for some other equipment that he needed for the business. Okay, because he didn't pay for any of that equipment and because DARS paid for it, that could be an example of an unincurred business expense because the client didn't pay for it out of their own pocket. So any equipment needed to run the business, or if DARS was to pay the cell phone bill or the internet bill or utilities for a certain amount of time, those are all examples of unincurred business expenses. Anything that the person uses in operation of their business but was paid for by somebody else. So either that or an unincurred business expense could also be expenses not specifically incurred by any entity. So an example of that would be if somebody operated their business out of the community center and the community center didn't charge that person for renting the space or for any utilities, that could be an unincurred business expense because the client didn't pay anything for that space, but the community center has to pay for that space even if the client doesn't pay anything. So unincurred business expenses artificially inflates net profit because the equipment or services that somebody else has paid for is allowing them to run their business. So the profits that they're actually showing on paper aren't really attributed in total to their work activity because without those expenses paid for by another person or agency, they might not be able to sustain SGA level earnings. So unincurred business expenses artificially inflate the profit because it shows a profit higher than what the person might be able to make on their own if they didn't get that help. Unincurred business expenses is deducted from net earnings from self-employment when calculating what's countable for SGA purposes. Okay, and I have an example in a few slides where I'll break it down and show you how it applies to an SGA determination. When somebody has an unincurred business expense, and that expense is being used to be deducted from profits when determining if somebody is over SG or not, it's usually done in one of two ways. One is by taking the actual value, where the actual expense amount is deducted from the net profits in the month that it was paid. And some common examples of that are monthly recurring charges that don't really fluctuate very much, like a phone or internet bill. That's an expense, if it was paid for by VR or another person, that could be considered an unincurred business expense, and the amount of that expense would be deducted from the profit in the month that the VR agency or another individual paid for it. If it's a big ticket item, something that costs, it could be something from several $100s to several $1,000s, Social Security is not going to deduct the cost of that item in 1 month. They're going to spread it out within a period of time, over several months or several years, based on the actual value of what the big ticket item cost is spread out by the number of months of useful life, similar to depreciation. So if you're buying a new car, as you drive the car off the lot, the value automatically goes down, the minute it leaves the lot. Same thing for these big ticket items. It's going to cost VR agency or the individual paying for it a certain amount of money, but the value of that big ticket item is going to go down the more and more it gets used. So what Social Security is going to do in situations like that is take big ticket items, the actual cost of that, determine its useful life, the amount of time that it's going to be used in operation for the business is an estimate, and then divide that up within the period that they're looking at. And I'll give you an example of that in just a minute. The other way to deduct unincurred business expenses is by using the fair value. And it's used for expenses not specifically incurred, such as free rent. So going back to the example I gave you of the client who operated their business out of the community center, and the community center wasn't charging them anything for rent or utilities, Social Security is responsible for determining the fair market value of the expense and deducts that on a monthly basis. Okay, so fair value is only used usually if an actual value cannot be obtained. If Social Security has verification of an actual value of an item and has documentation of what VR or the individual or agency buying the item spent, actual value is going to be used as long as Social Security can verify it. Usually what I suggest that people do is when they fill out that 820 form, if they have what could be classified as unincurred business expenses, like in the example of the client that Dars is working with, what I suggested that he do is put down the name of his VR counselor and the amount of money that Dars spent, so that Social Security can follow up with that counselor for verification of the cost of that item, for the purposes of determining how much should be deducted. Okay, so if anybody has anything like an IRWI or an unincurred business expense, there's going to be a place on the 820 form where people can list expenses like that they've got, or that were paid for by VR, as it were. Another thing that can be done too is when a person sends in that 820 form, if they have an expense that was paid for, like by DARS, for example, that expense is going to be listed in their employment plan. So one of the things they can do to show their unincurred business expenses is when they report their work activity on the 820 form, they can put their VR counselor's contact information down and also attach a copy of that employment plan showing what DARS spent out of pocket for that item. That's just one way to document what expenses a client has for reporting purposes. Let me give you an example of how this all ties together in terms of work incentives and countable income. This will help make it clear for everybody, I hope. So Kate schedules another appointment with you in January. So let's say she's past her trial work period and she's now in month 12 of her EPE. So because she's past her trial work period, Social Security is going to be looking at SGA and work incentives would apply now. Her business is generating an average monthly net income from self-employment of $1,900. This month, VR purchased a new $6,000 copier for her business. Okay, so that's an example of one of those big ticket items that I talked about on the last slide. Kate's accountant told her that the useful life of the copier was 24 months. Okay, so that's just an estimate that based on the amount of time that the copier is going to be used, she's going to get a good 24 months out of it for the $6,000 that VR spent. Okay. VR has also agreed to pay her monthly cell phone bill of $75 for 3 months. So from January to March, let's say DARS has agreed to cover the cost of her phone service for a specific time period. Could these expenses that VR purchases be applied as unincurred business expenses, and if so, how would Social Security determine how much to deduct? Okay, so as LaWissa, she's coming to you asking these questions, and we'll go through on the next couple slides how it works in terms of deducting for business expense purposes. The answer to the questions that she's asking is that both VR purchases can be applied as unincurred work expenses because remember, an unincurred work expense is an expense that the person uses to operate their business but is paid for by another individual or agency. So because she didn't pay for it out of pocket, but because their expenses related to her business, they can be deducted as unincurred business expenses. Okay, so here's what she's got in terms of expenses that can be deducted. She's got her phone bill that's going to be paid for by DARS. So Social Security is going to allow her to deduct $75 a month between January and March. That's the time period that DARS is going to pay the phone bill as a business expense. And then because the copier is a big ticket item that we talked about, Social Security is going to determine that she can deduct $250 a month in unincurred business expenses for the next 2 years. Okay, so $250 a month is going to be deducted from her profits to account for what VR paid for that copier. This is how they determine it. They're going to take the total expense, which we said was $6,000 a month. That's the total amount that VR is paid for, divided by the number of months that have been determined in the copier's useful life. That's the amount of months she's going to be able to get out of it. The remainder is $250 a month. Okay, that's how they come up with how much they're going to deduct every month for those big ticket items. It's value divided by the number of months of the item's useful life to determine how much monthly is going to be deducted in unincurred business expenses. Okay, so she's got, again, $75 a month in her phone bill that is going to be deducted from January through March that VR is paying for, and then $250 a month over the next 2 years to account for the copier. Okay, those are the unincurred business expenses that you as the WISA have identified. So after all the work expenses and work incentives are identified, the next question that the client's going to ask you is how Social Security is going to look at that in terms of the income calculation and determining whether they're over SJ or not. So I'm just going to break it down step by step and kind of recap what we talked about already in terms of what expenses have been identified and talk to you about how that impacts income and net profit. So the first thing that Social Security is going to do is look at the average NESC for 2023. Let's say she's worked from January to December, making $1,900 a month. Okay. From that, Social Security will deduct $75 a month in medical expenses for the IRWI. Remember, going back to that slide, we talked about how she had $75 a month that she was paying for copays out of pocket for physical therapy. So that was an expense we identified as an IRWI. And then after that's deducted, Social Security is also going to deduct $75 a month for the phone bill for the 3 months of January through March of 2023. Those are the 3 months that DARS said that they would pay the phone bill. And then they're going to deduct $250 a month to account for the value of the copier for the rest of the year. Okay. The phone bill and the copier are unincurred business expenses, as we talked about previously. So her countable net earnings from self-employment is $1,500 a month for January through March. Again, it's the $1,900. Subtract the $75 for the IRWI copays. Subtract $75 for the phone bill and $250 for the copier. That's how I got the countable NESC of $1,500 for the first 3 years of 2023. And then if you look at the rest of the year, April through December, her profit actually goes up a little bit by $75 to $1,575. And that's because DARS is no longer paying for that cell phone bill. She can no longer use that as an unincurred business expense. So that's actually going to inflate her profit a little bit. Okay. So her countable income at this point is still above the SGA figure of $1,470. And at first glance, it might look like she's in trouble, right? Because her countable income has been over SGA for the year and she's still getting benefits. In a normal case, SSDI would cease unless other work incentives and deductions applied. Okay. So when you're looking at how to apply deductions and work incentives, make sure you take into account all the work incentives that are available to the client when making that income calculation, because in her case, she might have some unpaid help, and we're going to talk about that in the next slide. The last work incentive I want to talk to you about is unpaid help. And like unincurred business expenses, unpaid help applies when a person is on SSDI and self-employed only. It does not apply to employees. This is a self-employment only work incentive. But Social Security defines unpaid help as the reasonable monetary value of any significant amount of unpaid help for business activities furnished by a spouse, children, or others. So others could be a friend or other family member. But the value of a help by a spouse, children, or others is deducted from net income. So that's an example of where a spouse, a family member, a friend is contributing their time and their skills to helping the person with the disability run the business, but they're not getting paid for their time. Okay? Just like an unincurred business expense, where an expense is paid for by another person or organization, the value of unpaid help can sometimes inflate the profit, because even though it might look like the person's making over SGA on paper, like in the case of our client example here, without the value of the services that the spouse or family member or friend brings into the business, that person might not be able to sustain that SGA level earnings. Okay, so almost look at unpaid help as if the spouse or family member or friend is working at the business as a volunteer and not getting paid for it. Okay, that's what unpaid help means. In estimating the value of unpaid help, Social Security considers the prevailing wage rate in the community for similar services. And I'll give you an example of that on the next slide. Just to give you a quick example of how unpaid help is applied to income calculations when a client has them. So in the example of our client Kate, in addition to having IRWIs and unincurred business expenses that help her run her business, Kate's mother is providing bookkeeping services to her company at no charge. Her mother is a bookkeeper and charges all of her other clients $22 an hour. Okay, so even though the mother can get $22 an hour, If she's working with other people in the community, she's providing those services to Kate for free as a favor and not charging her anything. It typically takes her mother about 15 hours a month to do Kate's company books, okay? So she's working about 15 hours a month, and she's foregoing her normal fee of $22 an hour. She's doing this work as a volunteer. If somebody has unpaid help that's being furnished by a spouse or a child or another family member, the family member should keep a log of the number of hours that they worked in the month and a brief description of the job duties they provided, and submit that to Social Security as documentation of unpaid help. Okay? Social Security is going to ask the person providing that help to the beneficiary with a disability to document the amount of hours spent, the estimated cost of what they're giving up to provide the service for free, and this should all be documented and submitted to Social Security when the client is working if they have those unpaid help expenses. Okay. So what Social Security is going to do then is they're going to take the information that was provided by Kate's mom and determine that her hourly rate of $22 a month that she's not being paid because she's volunteering, they're going to multiply that by 15 hours a month, because that's the amount of time that mom says she spends on the books every month. That leaves $330. And what that means is that $330 is the estimated monthly value of the unpaid help that mom is providing that's going to be deducted from her profits when Social Security determines whether or not she's earning over SGA. And I've got an example of that on the very last slide. So going back to our example, just to build on what we had, I'm going to add in the value of what we determined as unpaid help into the income calculation. So going back to what we had before, $1,900 a month was her profit before the application of any unpaid help or work incentives or business deductions. And because she's in her EPE, benefits would cease because her earnings are more than SGA without the application of any of these work incentives, or in some cases would terminate if she was past her EPE and continued to earn the SGA. But because she has deductions for unpaid help, IRWs, and business expenses, that stuff has to be taken into consideration. Okay. So what we said before was even with the unincurred business expenses and even with the IRWs that she had, her countable income was still more than SGA, meaning she would not be entitled to the benefits she received, and maybe she would have an overpayment. But when you add in the value of the unpaid help she also gets from mom, that's going to drastically change her situation. So what Social Security is going to do is they're going to take her gross profits of $1,900 a month. Again, going back to what we said before, deduct $75 for her IRWs, deduct $250 a month in unincurred business expenses. That's the monthly amount that Social Security has assigned to the copier that VR paid for. And then, as a final step, deduct from that $330 a month in unpaid help. That's the monthly value of the services, the bookkeeping services that mom pays for and is not being compensated for. Okay? So it's gross profit minus IRWs, minus unincurred business expenses, and minus $330 in unpaid help. Okay? So in our situation, in our client situation, she has the whole gamut of self-employment work incentives available to her. She's got IRWs, unincurred business expenses, and unpaid help that is all going to be deducted when determining if she's eligible for benefits. So without the unpaid help, her earnings are over SGA, and she would likely be subject to an overpayment. Once you figure in those unpaid help deductions, her countable income is $1,245 a month, less than SGA. So meaning not only would she be eligible for benefits still on an ongoing basis, but there would also be no overpayment. So when you have a client, whether they're an employee or self-employed, you're always going to want to look at every work incentive that could possibly be used to reduce their countable income. And that concept is no different from self-employed people as it would be for any employee that you're working with. Okay? So that is in a nutshell how self-employment works. I know that this is a lot of information and probably very confusing, so I hope that this webinar and some of these examples help break down and explain how Social Security does look at income in SSDI cases. And as always, if you have any questions or concerns as you're going through the webinar and through the material, you can always reach out to me by email or phone at any time. I would be glad to talk through some of the content of the webinar with you. Thank you, everyone.